Okay. So a couple events happened. So there was a STC came up with an announcement that they're talking about the new continuing ed for IARs. Don't confuse that with what we were talking about last week with the allowing you to go 7 years without having your licenses as long as you keep up continuing ed. That is not the same thing. This is a new proposal, which I think just passed. Ginger, how are you? This is a new proposal. I think it just passed and was just enacted, where they're going to allow. Carolyn, Kelsey, how are you guys? So what we're going to do is they are going to start requiring, if this goes forward, 12 hours of continuing ed for IARs, not for broker dealers, not for Michael, congratulations, you're on for the 7, right? When are you taking it? So we have 3 things. We have the FINE program, which I talked about, where they're going to help you find a job if you're not registered. 2, they came up with the proposal that they're going to allow you to have your no license. You're not allowed to be, after you take the 7, as long as you do continuing ed every year, you will keep that for up to 7 years after you leave your job versus the normal 2 now. The problem is they're fighting with the states because the states don't agree with it, but they'll make it work because FINRA will force it. The third thing is the IAR. Tonya, how are you? LV. So when are you taking this, Michael? And the third thing is this IAR thing for people who work for either a state or a federal IAR. They are going to require the proposal is to have 12 hours of continuing ed every year. Just Jody. So 12 hours. So it's 6 hours of product knowledge and then 6 hours of regs or something like that every year to keep it. Okay, so I just want to bring up Kelsey is hanging out in Cincinnati, and she is looking for someone or a group to do a study group for the 7. So if any of you guys want to get together and try to set up a study group, that would be great. Colleen, I just talked to you before. If you guys want to do that, just reach out to her. I think you can either reach them through me and we can connect, or you can do it that way. I think she wants to take it in the next few weeks, maybe a month or so. So if anyone wants to do it, I know you guys are all, I know that there was a group started, so maybe you can get her involved in that. Okay. There you go, LV. That's what we're looking for. Kelsey, you can reach out to LV. Her name is Laura, and you can go through me on and get there. So LV is going to be solid. Hopefully John. Yes, Savoy, it's the 63 is hard. You just got to keep reading. Okay. So if you want, the best way is probably I'll try to connect you guys email so you can talk to each other. And don't put your email on here because I'll have to delete it. I mean, I'll wait a second so you can see it, but Craig, you're back. How are you? That's awesome. You taking that? What are you taking now? The 66? Okay. Oh, every time that's true. I use it, but I don't drink. I haven't had Diet Coke in almost a week. So I'm drinking this crap. This powdered drink that's no sugar in it. So I'm dying. Mark, what is the analysis stuff? Whose vendor are you using? Okay. They're LV. Take a look at that, and I'm going to delete it in a second. If you want to do a group, and I think there's a girl Cynthia in here who might be. I don't think she's in Cincinnati, but she might be in Missouri or something like that. And to me, they're the same because they're the places that I can go. So LV, take a look at that email, and then I'm going to delete it so it doesn't stay on there forever. John, I just saw you. Everyone, John's taking it soon, so we got to force him to feel confident. Okay. Boom. Okay. LV, if you didn't get it, okay, perfect. Okay. So Past Perfect. Yeah, the problem with the Past Perfect is that their analysis and math is an ass kicker. It's really, really, really hard. Okay. Yeah, I can do that. So really, Mark, focus on the concepts of the analysis, like the present value, future value stuff. I tell everyone to go to Investopedia and go to Khan Academy. They're free, and it has a great They do a great job, and they do a little cartoony. Investopedia does it for the 66, but the there you go. It looks like we're building up a little group. Okay, I'm going to put it up there for a minute, and then I'll let it go. So LV, if you want to write that down, if you guys all to get together, okay. If you guys don't get it, email me at kenfinnan@gmail.com, and then I can connect you all with a group. And anyone who watches this tomorrow, if you want to do a group, the same thing. Okay. Yeah, see, I told you, Kelsey, it really works if you can do it. So you get a nice group, you get a Zoom thing going. Okay, good. Okay, so take it, get rid of that. Remove. Mike, I just take it off so that okay, boom. LV, you're gonna be busy, you're gonna have a hell of a study group. This would be good. Okay. Boom, LV, if you don't get it, just remind me, I'll go get it so I can find it. Okay. I can hide it. No, I don't want to hide the person. Okay. Remove. You're still there, I hope. Yeah, okay, good. I got the delete. Okay, good. Okay. That's awesome, you guys. So perfect. Email me and then I'll get you the names. Okay. So everyone, instead of putting it on here, that's easier. Everyone email me at kenfinnan@gmail.com and just put study group and I'll know, and then I'll send it all over to LV and she can work on getting a group together and we can go. Yeah, if you watch in the beginning, this firm element's not for everyone. It's for IARs, they're going to require 12 hours. That's what it is. Now, we talked about accrued interest. So let's talk about accrued interest a little bit. We know that bonds that pay every 6 months, if you buy a bond, a normal bond, it either pays every 6 months or at maturity if it's a zero coupon. So if it's a bond that pays every 6 months, okay? So what happens is, if a bond that pays every 6 months, let's say it's a J&J, which is January and July, not Johnson & Johnson, okay? So if it's a J&J bond and it pays every January and July and you own it in like May, okay, you own it from all the way through and then you sell it in May. Well, you've kind of been earning interest from January to May because it's a bond and you've been earning interest on it. And if you sell it, well, the person who buys it from you is going to get the entire, $50-$60 in July. So some of that's your money. So they have to pay you all of the interest that you've earned. Ask me that again in a minute, John. Just after I'm done with this. So they're gonna have to pay, the buyer is gonna have to pay the seller of the bond all the interest that they earned from January forward. So let's do this quick. I gotta figure out how to do this on the OBS so I can do the screen. So let's say it's a J&J bond, January and July. Let's say you buy the bond on Monday, May 10th. Now remember, if it's a corporate or muni, every month is 30 days. And if it's a treasury, it's actual. I will not do the actual because I can't do that math. Okay? So now, we buy a bond. Let's say I buy a bond on Monday, May 10th. Okay? Yes. Monday, May 10th. It means it settles on the 12th of May because it's 2 plus 2. You count to the 11th because remember, on the 12th, it's that person's bond. So you count up to the day before settlement. Remember, if it settles on a Monday, you count to Sunday, not Friday. So if I buy it on Monday, May 10th, I count to the 12th. Boom, that's the 12th. The 12th is not mine. It's the other person's. Okay. You got this, Matthew. Okay, so now, I thought you took it already. No? Okay, so let me know if you need help with it. Okay, so now. Young, how are you? Okay. Could keep reading. I know I'm getting interrupted. So keep on the reading. I got it. Throw them in here. If they're not, remember, if it's options and crazy shit, I'm not doing because that's how I make my money. So now, buy a bond on Monday, May 10th. It settles on the 12th. They count up to the 11th. So then there's 11 days in May. That's easy. Okay. Now we go all the way back. Remember, we go backwards. So we'll go back to the last payment date. So we're going to go to January. So January's 30. January, February, March, April. January, February, March, April. 30, 30, 30, 30. That's what's 4 times 30. That's 120. Plus 11 days in May. So that's 131 days. Justice, how are you? So that's 131 days of accrued interest. If they make you do the math, I'll come back to you on that. But then usually they don't make you do the dollar amount. But this is what I do. If you really want to figure it out, we know that it's a muni or a corporate, which means it's a 3360. Say we have a 10% bond. Diaz, how are you? So now, if we have a 10% bond that pays $100 a year, divide 100 by 360, say that works out to be 27 cents a day. So that's 27 cents a day of interest that you're earning for 131 days. So multiply 27 cents times 111, and that's the dollar amount, okay? And then if it's 3 bonds, 4 bonds, 5 bonds, you just multiply on that, okay? Okay. I hope that helps with the accrued interest a little bit. And just remember, if it's a treasury, when you buy the bond on Monday, May 10th, it settles on the 11th, so you count to the 10th, not the 11th. And it's actual days. January is 31, February is 28, March is 31, April is 30, and May is the 10, okay? I hope that helps. But always remember, you're going backwards to the last payment date. So if you see a bond that trades and interest, okay? If you see a bond that has, if you see a bond, Carol, that's good. Email me at kenfin@gmail.com. I'll give you all LVs, everyone's, okay? Now, always remember, you go backwards to the last payment date, okay? That's the big one, okay? I'll work on that, Young G. Okay, so now, Richard, awesome. Just get through the book. That's the big thing. Okay. Now, I think somebody answered something before I do while I'm talking, a due bill, while I'm looking for the other thing. A due bill is if you sell short stock, if you short stock or sell stock, and somehow it should have been before the X day, and somehow it settles after the record day, the company might give you the dividend by mistake. So they ask for the dividend back. A due bill is really just the broker dealer who lent the shares to you asking for the dividend back to a short seller, because that's what so what happened was, see, I'm trying to read it. I'm not smart enough to do that crap anymore. I used to be able to do 3 or 4 things at a time. So now, and then what happens? I forget everything because I'm a freaking moron. So now, a due bill is I short stock, and by mistake, I remember shorting stock is borrowing shares, selling them, hopefully they go down, buy them back. But sometimes you sell them short by mistake. We sell them short and you get the dividend by mistake. You're not supposed to get it because the settlement happened at the wrong time. Don't worry about that. A due bill is when the broker dealer who lent you the shares asks you to send them back. Not really ask, they tell you to send them back. So you'll get us a question. If you short stock, what happens if you get a dividend by mistake? Send you over to the lender, you have to give it back. And remember, on a short sale, there's no time limit of when you have to give this shares back or buy them back. It's just, if they can ask from any time, but there's no specific time limit. Okay. No, let's keep going. We got this. Everyone's moving along. Yeah, just keep in mind, I forgot who I was talking to. Mark, was it Mark? About Past Perfect. Again, go to Investopedia or Khan Academy for some of that stuff. Because remember, don't worry about the heavy details on the analysis. Present value, future value, stuff like that. Get the concepts down. That's really big. No total return. Okay. An equity inverse ETF. So an ETF is this. It's a packaged good. LV, remember? So here, it's a package. So here's what happens. We fill, this is iced tea that I just powdered crap. So you fill this with securities, and then you kind of cap it off, and this will trade up and down, because that's what an ETF. It's like an open-end fund, but it's not really traded. It's not really. Let me back up on this. An ETF is technically an open-end fund, but it acts like a closed-end because it's a share price. It trades on an exchange. What they don't do in here is they don't trade it very much. The actual ETF will trade on the market, but the securities in here, they just kind of rebalance. So a regular ETF, say it's the FANG stocks, it'll go with the index just like this pretty much, okay? If it's an inverse, it'll go opposite. So basically, it's like shorting the stocks. So if you really hate the S&P 500, say you think COVID's going to get really bad in the next couple of months and we're going to hit a crash, you would buy inverse. I'm not telling you to do this, guys. I'm just giving you an idea. Hey, Allie, by the way, hello. I thought I saw you on there. Okay, so I might even have said hi. If you think the market's dropping, you would buy an inverse ETF. So as the market drops, the value of your ETF goes up. That's one thing. Now, the other thing is it goes like this, but then they have leverage where if the market goes up 10, we go up 20. Market goes up 30, we go up 60. Market goes down 4, we go down 8. That's a 2 times. Then they have a triple, which is if the market goes up 5, we go up 15. If it goes at 10, we go up 30. So they do the same thing for inverse. So if you have an inverse 3 times ETF, market goes up 10, you'll go down 30. But if the market goes down 10, you go up 30. And that's what that is. So it really just moves, a regular ETF moves with it, an inverse moves opposite, and then the leverage move more, and it's just a multiplier. Hope that helps, Jimmy. Okay. You got the due bill. Okay, the 75-5-10 rule. So a stock is a mutual fund, a diversified mutual fund has to have at least 75% of its assets invested in something. No more than 5% of the assets of the fund in any one security, and they can't own more than 10% of the voting stock. Okay? They can't own more than 10% of the voting stock of a company. So to be deferred, to be considered a diversified fund, 75-5-10, 75% invested, no more than 5% in any one security, and you can't own, and that of that money, of those investments, you can't own more than 10% of the voting shares. Okay, let's see what else I can find. Now, okay, so now, where are we? I think we got more stuff going on here. Where are we? Close tabs. Yeah, but don't shut down my. There it is. I know I'm talking, guys. You have to deal with it. Okay, so now. Okay, so understand what's up. So I did watch sale last week. I'll do it again though. So here, so K shares, so preferred K shares are like they're convertibles, not convertible. They're variable. So what happens is it's an adjustable rate. Usually there's the first couple of years where it's set, or the other way around, and it'll basically, as interest rates go up and down, it'll go up and down with it. So they're just adjustable. So they really don't. Once they start adjusting, they don't have any interest rate risk. Okay. That's kind of it. That's the big thing. So a lot of times they're not cumulative. You don't remember cumulative is they're called floating rates, because what happens is they're moving with the interest rate. So if you have a 4% K share and rates go to 5, it goes to 5. They go to 8, it goes to 8. Goes to 2, it goes to 2. Okay. Hope that helps. Okay. And they usually have some sort of preference over the other preferreds for some reason. Okay. Now let's keep going on. Okay. So the wash sale, a tax swap and a wash sale. So a wash sale is when you sell shares for a loss, so you can take the loss, but then you buy back the stock within 30 days. That disallows the loss. Okay. So if you sell shares for a loss and then you buy it back within 30 days, you still lost the money, but can't use it against your taxes. That's what a wash sale is. It just disallows the loss. Okay. And what they do is they adjust your cost basis to reflect it so that you can take the loss at a later date, not now. So a tax swap is when you do it with a bond, as long as you change two out of the 3 features. So if I sell an IBM 9% 9-year bond for a loss, I can buy back an IBM 10% 10-year bond and I'm okay. Because if I bought back the 9%, the exact same bond, I'd have a wash sale. But as long as you change 2 out of the 3 features, the 3 features are maturity date, issuer, and coupon. If you change 2 out of the 3, it's considered different enough, and it's not a violation of the wash sale. I hope that helps you. Okay. Got it. Okay, that's fine. Okay. Exempt securities. I do have a video on it, so I definitely have a video on that. So watch that. Okay. Remember, everyone email me. I don't know if you're doing it yet, but email me at kenfin@gmail.com if you want to join that study group, and I'll shoot you out to Elevate. But let's all. It's for the 7. This is for the 7. If you want to do one for the SIE, we'll find someone for that. Okay. Yeah, everyone. If you like what I'm doing, please hit like. Okay. So now, okay. Yay. Good. Yeah. Wow. So get the fuck off my thing. How about that? Boom. There you go. You're gone. Okay. Now we'll get rid of you. Because if you're boring, go. Nice. Okay. He wrote a lot of shit. I wonder what he wrote. Okay. 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 I don't know what that means. There's no real hard exam. Okay. So There you go. Just wanted to read what Yetwada said. So, the hell. Boom. Okay, so now we're back to this. So now, Not Mark says they prepare you for the potential hard exam. I don't know that that's true. There's no such thing as a hard exam. It's just everything's random, and you might get just hit with it. That's all. Hey, Hallie, again, you're back. So, don't worry about it. Just prepare. Work on the reading. Watch my video on exam securities, and then we can talk about. And when we meet, we can go over the other stuff. But it's the 63. I'm not saying it's easy, but it's 100% doable in the first shot if you study for like a full week. Okay. Boom. Okay. Let's keep going. Shauna, that's fine. I'm happy to help. Okay. Boy, Yetwada must have been born. Okay. AR. So this is what you do. When did you fail it? Okay. So look, understand there's a lot of people who miss it the first time. I don't call it a failing. I call it a miss. So if you miss, okay, that's fair enough. Oh, I didn't see that question. I'll come back to that. Okay. Let me go back. So let me hit AR and then we'll come back to it. So I was worried about getting Yetwada off of Yetwada Raka, whatever is wrong. Okay. 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 So if you fail, I have a what if you fail video. If you fail, so first thing you do, write down everything you need to remember about the exam. Just remember, write everything down. Then take a day off. Just relax. Then go back. Since you have a month, just read the book. Read the book from the beginning. No notes, no nothing. Okay? Just read it and try to get, and you'll remember stuff that you saw in the exam and stuff like that. So go for that. Okay? That's the best thing to do. And don't worry about this. As I tell everyone, if you fail or miss, it's a 30-day problem in a 20-year career. It's not even a big deal. Okay. Okay. Now, boom. Got it. Boom. Okay, so now, there we go. Now, let's keep going. So let me see what else we got. Okay. Okay, Carol, I have a formula. I think I have a formula. I have a video on formulas. That's the best way to look at it because you need current yield, you need PE ratio, you need earnings per share, you need to know the margin stuff, you need to know how to do splits. You're going to have to do tax equivalent yield, tax-free yield, stuff like that. Okay, Justice, you have to. Yeah, the math is. It's not. Mark, again, the math isn't that bad. I know I'm jumping all over the place, but I'm trying to catch up. So, the Ginnie Mae, Fannie Mae, Freddie Mac stuff, you got to understand the concepts. Like you have to understand what a pass-through certificate is. You have to understand that Ginnie Mae, G for government. Ginnie Mae is guaranteed by the government. Then you have Fannie Mae and Freddie Mac. Those are still agencies. They do mortgage-backed securities, but they have some risk. Okay? That's kind of the thing. See, they absolutely have some risk because Ginnie Mae's don't because they have the government backing them. Fannie Mae, Freddie Mac, they have some risk, and they pass through all the stuff. They pass through their the income that you go, and that's what their pass-through certificates. Okay. I've done that a couple times. I'm working on it. I might have a video on it. Take a look first. If not, I can do it on Thursday. But I've done the sell stop a bunch of times. So if you suffer through some of the lives, you might be able to find it. Okay. Okay. I think she said. Oh, so also the leading lagging indicators, don't sweat them too much, okay? The leading lagging indicators are leading is telling us the future. Lagging is where we were. Coincident is now. They're not going to make you remember all freaking 36 because there's 12 of each. But remember, a leading indicator tells us where we're going. A coincident tells us where we are. Lagging tells us where we were, like corporate profits. S&P is a number one for telling the future. Okay. Okay, now, Melissa. Can you give an example of margin account question and the regulation of margin account? Okay. I took top off practice and missed the 3 margin account questions I got. Okay. So, thank you, Colleen. I tried to. Okay. Now, understand. So, margin account question is like this. So, if I get margin regulations, it's a soft G and a hard G, and it screws me up. Like the regulations, when you open an account, you need a hypothecation agreement. You need a credit agreement. Those have to be signed. You have to send them a disclosure doc. The loan consent doesn't have to be signed because it's optional. That's kind of the regs. You can't have less than $2,000 in a new account. You can't have less than $2,000 in equity, or less than 25% or 30% on the short, 25 on the long. Those are the regs. They're going to say stuff like, you sell short 100 shares at 3,400. What's your deposit? Well, you'd normally go, okay, well, 50% of 3,400 is 1,700. That's okay, but it's less than $2,000, so $2,000 is a minimum. That's a question. The other question you get is this. You have a market value of 50,000. You have a debit balance of 20. What's my SMA? Okay. Well, I have a market value of 50, a debit of 20, so my equity is 30. Market minus debit is my equity. My equity is 30,000. That's great. They would like me to have at least 50% of the market value. So 50% of 50,000 is 25,000. So if I have 30,000 and they want me to have 25, I have an extra 5,000 over what I need, which is that 25,000 is called Reg T. So I'm going to do equity minus the Reg T to get my SMA, and that's going to be 5,000. My SMA is 5,000, and always remember, if it's buying power, double the SMA. So again, market value of 50, debit of 20. 50 minus 20 is 30,000. That's my equity. 30,000 minus the Reg T amount, which is half of 25,000. Half of 50,000, which is 25,000. 30 minus 25 is 5,000 of SMA, and 2 times buying power. Hope that helps, Melissa. Okay. So if you're a quib, yeah, I think somebody made it. Somebody answered that. But a quib is a firm, not an individual. It is a firm that manages at least 100 million. That's why it's called a qualified institutional buyer. A quib, qualified institutional buyer. So it's at least 100 million, and they can kind of get away with a lot of stuff. But the key one is under 144A, you can sell restricted shares to quibs anytime you want. Okay. Because remember, the whole point of 144, that holding it for 6 months, is to prevent you from buying like a Reg D offering and turn around and flipping it around to grandma. So they figure because she can't protect herself. But a quib, they manage 100 million. They can protect themselves. You can sell it to them. That's the advantages of being an institution or an accredited investor or a quib. Each level lets you do more things. Like an accredited investor can buy on Regulation D and private placements because they have money and they're sophisticated. An institution can do more things because they're an institution. A quib can do almost anything they want because they're big and they can totally defend themselves. So they're basically telling FINRA, we don't need your protection, so we want to be able to do more things. Where little grandma, grandpa needs FINRA's protection, so FINRA's going to limit what they can buy. Okay. Beautiful. Okay. I don't know who that is. I don't know what that is, but okay. Okay. Okay, let me keep going. Okay, AR, I hope you have an advice. Just focus on reading the book. 64, not even a big deal. Just read the book. And if you understand, if you're still on here, AR, if you're using like ExamFX or AD Banker or NRS, get rid of it, get a new one. Go on my link, you can get the Achievable. It's cheap. You can go on the link, get the STC. If you don't want to do that, get Kaplan Past Perfect Training Consultants. All of them are solid. Maybe if they're one of the ones, AD Banker, ExamFX, or NRS, I would find a new vendor. Okay, and read. Yeah, Matthew, correct. Okay. Mark, that's a great question. I don't know. I do think it probably has to be signed. Hope the Bills are winning now. Okay. Charles Manley, isn't there like a Manley who played for the Bills? Okay, so now, an investment statement policy, I think it would have to be signed and notarized, but I'm telling you, if that's a question on the exam, I'd be super, super surprised. And I would think it was one of those test questions. Okay. Yeah, okay. MX, the problem with Past Perfect, it's so much, okay? It is so much stuff. Oh, they did. The Jets released Le'Veon Bell. They were trying to trade him. Okay. I'm a Jet fan. It's painful. I deal with it. Okay, I'll get to that in a second. Well, non-traded versus regular, right? Okay, so now, MX. Yeah, it's a lot to go over. Don't worry about memorizing. And the Past Perfect stuff is a lot. If you want a cheap one, and look, if you don't use it, it's fine. Okay. if you go on my thing in the Achievable, it's like $90 or something like that, and you can get, okay. So it's more about understanding the concepts. I like Past Perfect because they really control it. But if you're having struggle remembering, maybe get a different vendor, maybe go on Investopedia, watch these things, try to get the, Kirsten, how are you? Try to get the concepts of everything they talk about versus memorizing every little detail. And that's the other thing. Past Perfect has a lot of details that are not needed. So this is the way you have to think of it. If it's something the retail customer has to know it. If the customer doesn't need to know it, kind of know the concept. Okay. Now, and actually, I hope that helps a little bit. Just maybe find a different vendor that's a little bit. Oyad, I guess. Hi, how are you? Okay. An aggressive. Okay. So what's an aggressive growth fund? Okay. Aggressive growth fund is just a mutual fund that invests in like growth stocks, and like they're more speculative. It's riskier, high risk, high reward, but you are paying fees for. Remember, the mutual fund is fine. It's trading, so they're trading and actively trading it, but they're really staying in the growth fund section, like tech stocks and stuff like that. Okay. That was on the test. That's impressive. So I would say, if anything, I would say yes, because it has to be signed and notarized, because it's the policy of the mutual fund. So I think it does. Okay, Justice. Non-traded REITs versus regular. The big difference is that regular REITs are liquid, and they're liquid. They trade on exchange. Non-traded REITs are not as liquid. I mean, they're not even over the counter. You can't really trade them, but they all do the same thing. They have a central thing. They invest they have 80% of their stuff in real estate. They have to pass through 90% of their income. They don't pass through losses, only gains. So all the functions are the same. The biggest difference between non-traded REITs and regular is the liquidity. That anything on an exchange is liquid. Okay. So, wow, that's okay. So let's say, debt per capita is how much debt they have. So I would go, okay, so they have 20 million. If Fulton County has 20 million, Atlanta has 100 million existing debt. And this is a question on Past Perfect. Okay, so now Atlanta has 100 million of existing debt. It makes up 60%. Fulton 60%. Holy crap, I can't even think this way. Melissa, you got to tell me who's given that to you, because if that's Past Perfect, there's no way they're going that deep. Now, if it's on the exam, we can work on it, but there's no way they're doing that crazy, because debt per capita is how much debt we have per people. So whatever we're doing, we're dividing by 2 million. So if I have 100 million of existing debt, it makes up 60% of Fulton County. Oh, okay. So see, okay. Yeah, get rid of it. Exam FX is ridiculous. Okay. But what I'm saying is 100 million of existing debt that makes up 60% of Fulton County assessed valuation. Oh, so they're trying to say that 100 million is 60% of the valuation, and Fulton County has $20 million of debt. If they want to know the per capita for Fulton County, I would do 20 divided by 2. That should be 10. Okay. Yeah, I'm telling you, Greg, it's not a lot of math on the 66. It's much more about theory. Okay, Justice, I need a market price, so you can't do intrinsic. Actually, I'll tell you right now, it's the amount below. Hold on. Let me hit Kirsten's first. Okay, Kaplan classes. The Kaplan classes, the on-demand classes, the problem is, look, I'm not a young guy, and they make me look like I'm a teenager, the people reading them. They're really just, okay, awesome. They're kind of painful to listen to. Now, the on-live ones might be okay, but the on-demand ones are kind of horrible to listen to, the videos. But remember, focus on the facts, focus on risks, focus on memorizing the rules and stuff like that, but get those risks down and get the products. Know what each product does. Know what common stock, preferreds. That's what I don't just do lives. I have all these old freaking videos that talk about common stock, preferred. Get those and then read the book. And I'm telling you, everyone who's taken the SIE, do not take the one on the FINRA site until you're ready. Okay. The STCs, I think they are less painful. And if you want, I have the link in here. You can buy stuff, but if not, it's totally cool. We're having fun. So now, Oh my God, I'm an idiot. Where was I talking? Holy crap, I can't believe. Do you hate when that happens? It's unbelievable. Okay, so I'm trying to think of 3 different things. I got to stop reading. Okay. I'll come in. I don't know what I was talking about. Maybe you're going to mind me. Okay, so let's go back to this. I think somebody asked a question. Yeah, so that's the thing. So, Mark, I would try to find not, you don't have to buy another vendor, but I'm saying go to Investopedia, go to Khan Academy and get stuff, get some, what do you call it? Get some help with like the concepts. That might make it easier. I guess I'm getting old. I'm going crazy. I don't know. Okay. Okay. So now, how would you find intrinsic value? Okay. So if we have a put, anything below the strike price, okay? Anything below the strike price is intrinsic. So if you have a 30 put, whether you bought or sold, it doesn't matter. At 29, it's $1. At 28, it's 2. At 23, it's at 27, it's 3. At 20, it's 10. Anything below the strike price is intrinsic or in the money. Has nothing to do with premium. If you have calls, doesn't matter buy or sell. Anything above the strike price is in the money. And actually, I'm working on a margin video. I'm going to do one with the screen and everything. I figured out how to do it on Zoom. So I'm going to post that. Hopefully, I'm working on it tonight after you guys are done. Okay. Because I have no students tonight. It's great. I'm finally. Oh, wait. I think I do. Shit. Okay. And I think I got him in about 2 minutes, I think. Okay. So now, prohibited practice has his appearance of. So prohibited. So, Mark, can you explain that a little bit more? And I'm going to kill it with that one. I think I'm going to end it with that one because I think I do have a student. It's funny how that happens because I forgot he added it at the last second. Great guy, though. Okay. Mark, try to give me a little more color on that question. Because prohibited practice, like churning. Okay. Oh, awesome. That's great. So it is 63 video. Oh, maybe I did I don't know if I did a 66 one. So churning, so basically there's front running, there's wash trades, there's trading pools. Those are all violations. There's marking the open, there's marking the close. Those are all like marking the open and marking the close is placing a bunch of trades near the open or the close to make it close or open at a certain price. That's a violation. Capping is trying to keep it from going up too high. That's a violation. Pegging is trying to make it stay at a certain price. As one of my students says, don't Google that, please. Just trust me. Pegging is trying to make it okay, an appearance of trading. I don't think wash sale is it. Oh, wash trade. Alejandro. Yeah. Okay, I got it. Prohibited practice shows the appearance of trading. It's a wash trade, not a wash sale. A wash sale is when you sell stock and you sell stock for a loss and buy it back too soon. A wash trade is when if you have an account at JP Morgan and you have one at Goldman and you buy and sell it at the same time, like buy and sell it from each other so that yourself, so there's no change of ownership, that's an appearance of trading volume. Okay. Alejandro, you got on and then I'm heading off. I'm killing it because I got a guy in I got a guy 8 minutes ago that I was supposed to start. Okay. Well, we can listen, Alejandro. I didn't do a lot on 66. I did a little bit. The guys were talking. If you roll back, keep in mind, get the regs down. That's going to be the hardest part for everyone. Don't. So I would focus on getting the regs down. That's half the 66. The other half is don't focus on doing the math. If you get more than 1 or 2 math questions on the entire 66, you got way too many. There's no way you got them. It's pretty much under 3 questions. Anyone? I am heading out. I do have to teach. I have another student. I think I do. I don't know. I'm nuts. They just show up on my calendar. Everyone, may the force be with you. See, Greg, I remembered. Wash your hands. See you guys Thursday. Come up with some questions. And we will talk to you later. Congratulations. Tell people that I'm doing this because I want it so many people that I can't keep control. I mean, that makes it fun. Okay. You all have a good night.